AI is rewriting the markets, so today 2 ETFs step into the ring. It's DRAM versus AIQ. One leans into the explosive hardware powering the AI boom, while the other bets on the companies shaping its future. So which strategy wins? Let's battle it out. You're watching ETF Battles. I'm Ron DeLegge. Great to see you. Welcome to our original series. We're deep into season 7 and pumped to have you here. Join the community by hitting subscribe and drop your ETF battle requests in the comment section below. Give me your exact tickers and make them good. Join me live on July 23rd for how to de-risk your portfolio before the next market downturn. It's free, but space is limited, so lock in your spot now. It's July 23rd. The registration link is in the description section below. Do not miss it. Today's ETF contest was requested by a viewer named 1309GSK, and it's a contest between DRAM from Roundhill Investments and AIQ from Global X. So which ETF is the better strategy for capitalizing on the AI boom? Thank you so much for this ETF battle suggestion, 1309. Judging today's matchup, we've got a duo extraordinaire. We've got Shana Sissel with Banríon Capital and John Davi with Astoria. And Shana, real quick, just a shout out to your son, Gabriel, who is now a national champion in karate. So now we want to give him, and we know where he gets that competitive spirit. He gets it from his mom. So congratulations to you on that.
Thank you so much. He got to fight on the big stage, and I said to him, I said, if you're anything like me, when the lights are as bright as possible and the crowd's as loud as possible, then you will absolutely take it up 3 notches. And he did, and he won the Kumite National Championship in his age group at the AAU Karate Nationals last week, and I am like over the moon proud.
Congratulations. Quite the athlete. John, great to have you with us, and thank you both for being here.
Great to be here.
Thank you.
So we've got our 4 battle categories: cost, exposure, strategy, performance, and then the mystery category. Mystery is where our judges can choose any factor or criterion that they think is imperative, or not imperative, but important to today's contest. And our judges, of course, can also nominate wildcard ETFs if they feel that there's better choices elsewhere, or they can opt for split decisions. So I'm going to be keeping score. Keep in mind, none of the battle outcomes are ever predetermined or known in advance by myself or our judges. The first category is cost. Let's kick things off with Shana. Please get us started.
Yeah, so in this battle, the expense ratios between the 2 products are pretty close at 68 basis points versus 65 basis points. And the spreads are pretty close as well. But I'm going to give it to DRAM just because with the larger asset base, which I had to do like a triple check because this seemed crazy, but they just launched the funds like 2 months ago, and they already have $22.8 billion in it. So I'm going to have to give it to DRAM for the slightly lower expense ratio, similar spread, but liquidity is always easier when the asset base is larger. So DRAM is my winner in cost.
Thank you, Shana. That's a strong start. And yes, this is a brand new fund. It's just launched a couple months ago. And typically we don't do new funds on ETF battles. They have to have at least a 1-year performance history. But DRAM has been an exception. It's been one of the best ETFs, biggest launches and fastest in AUM growth. So we make an exception. John, you're up next. How do you see when it comes to cost?
Nothing more to add. It's cheaper than than the competitor AIQ. So it's an epic ETF. It's defied all odds. It's the quickest, asset gatherer in history. It's done better than gold, emerging markets, Bitcoin. So shout out to Roundhill. I think those guys are geniuses. And nothing more to add. They win on cost.
That takes us next to exposure strategy. This is where we analyze what is inside the ETF and how does it allocate as well as diversify. So, John, break it down for us. How do these 2 ETFs compare?
All right. So they're very different. So I gave a big shout out to Roundhill. This is like one sliver of the AI trade, right? Just memory stocks. So basically, you have to have 50% of your revenues tied to, the semiconductor memory plays like, HBM, DRAM, NAND flash. SSD. I mean, it's a very concentrated, portfolio of a few select stocks which drive it. So 75% is like in 3 stocks. So, my whole firm is based on like diversification. How do you generate, higher risk per unit of, how you generate returns, per lower unit of risk. So we'd be more inclined to use something like AIQ if we were going to like really sort of play the AI trade. But, there's a market for everything, and obviously they solve for something very specific. AIQ, on the other hand, is, been around for a long time. It's more of a pure play on the AI trade, let's say. It's index-based. It holds 84 names. And it's really sort of benefiting. It's owning stocks that benefit from AI development plus AI hardware, enablers. It's split into 2 categories: AI developers, AI hardware, quantum computing. So it's just like a very, very different ETF. Both have their use cases. We'd be more inclined to use AIQ, but DRAM has done an epic job.
All right, got you down for AIQ. Shana, you're up next. How do you see it when it comes to exposure strategy?
I don't have a ton to add. John kind of said everything I was going to say. DRAM is a very niche play just on memory and storage chip companies, and 3 stocks are 75% of the portfolio: Samsung, Micron, and SK Hynix. And some of the strongest performance, I think, comes from Micron, and SK Hynix just announced that they're going to list in the US with an ADR. That's going to help that stock as well. I think it's listing on the NASDAQ, which means it's likely to be inclined to be included in the NASDAQ 100 index, which will help this product even more. But it is really niche. And as well as it's done recently, it could turn very aggressively the other way at any time. So I'm with John on this. I do prefer AIQ. It is more diversified. It has the 2 different areas it works with in the AI developers and AI as a service providers, as well as hardware and quantum computing. The top 60 companies in the first category, which is the developers and the AI as a service providers, are market cap weighted. It's the top 60, and the category 2, which is quantum computing and hardware, it's the top 25 companies. The minimum market caps are different. In category 1, it's 2 billion. Obviously, there's more players in that space. In category 2, it's 500 million. So you get some smaller cap exposure there. They focus on 3 main drivers in terms of what's really pushing the portfolio, which is growth, high growth potential, rapid commercialization, and they use an unconstrained approach. So they're sector agnostic. So it really just has to do with the AI exposure. There is no AI category, and not all AI names are in the tech sector. So I do like that. Max weight is 3%. Minimum weight is 0.3%. So you are definitely getting a much more diversified portfolio with AIQ. And to me, I think that I would want exposure to the entire theme and not just this very narrow area where it's basically 3 stocks and I live and die by the 3 stocks. I'd rather buy the 3 stocks or have a much more active approach if I'm going to be that concentrated. And that is not the case with DRAM. It is not an actively managed fund, and it doesn't reconstitute or rebalance regularly. So if one of those stocks goes horribly wrong, you're kind of riding that negative momentum. And it's worked out so far, but the fund is 2 months old. So, it is what it is.
Well, that takes us next to performance, and we'll see how it looks in this category. Of course, DRAM has very limited performance history, but give us your analysis, Shana, on this area.
Yeah, so DRAM clearly is the top performer. I mean, it's returned over 16% in the last month. It's up over 120% since its inception, basically in the last 3. I'm going to throw a wild card in here, though, because if I'm going to get exposure to this particular theme, there is another ETF that I like better as the queen of alts. This isn't going to surprise anybody because this fund has an alt twist to it, which is the Crane Shares AI Public-Private. The official name is Crane Shares Public-Private AI Tech ETF. And it is actually got stronger performance than AIQ. And
What's the
has a
ticker on
nice.
that?
I'm sorry. The ticker is AGIX. And it has strong performance as well. It has a longer track record. Definitely has slightly better performance than AIQ. And I think that's because it can have up to 10% of its portfolio in private companies. And as of today, the two private companies, or actually only one's private anymore, that it had in the portfolio was SpaceX, which obviously just IPO'd, and the fund has benefited from that. But they also own about 3% in Anthropic in the portfolio. So this is a fund that can have up to 10% of its holdings in a privately held companies. I think in this theme, I would want that because a lot of the best names are staying private for a long time. And their IPOs tend to be pretty splashy. So I'm going to throw this wild card in, AGIX. I have a very hard time giving DRAM the win in this category because it was launched in April. What are we talking about? I can't feel confident in what I'm getting. So I'm going to give the win to AGIX, which is my wild card.
Got it. And you're exactly right. There's not enough data, in fairness to DRAM. John, you're up next. How do you see it when it comes to performance?
So I definitely agree with Shana. So we're going to compare our performance of AIQ versus RSPT. So we have a wild card too. That's just the equal weight technology ETF from Invesco, S&P 500 equal weight technology. So we're big fans of equal weight. We just think that, sort of let the market, do the work for you and figure out the winners and losers. So year to date, RSPT, the equal weight S&P 500 technology ETF, has beaten AIQ by about 12%. Let me just pause there for a second. So, we have this firm view that it's not even a view. The Mag 7 stocks, if you look at the Round Hill ETF Mags, right, it's down on the year to flat, right? So the AI trade has sort of lost some of its momentum and the market is rotating and there's other winners out there. So we just think that sort of it depends on when you get into the AI trade, right? We'd argue that the best time to make this money would have been 2, 3, 4, 5 years ago when expectations were low, valuations were low, and these stocks would have outperformed, expectations. So something like RSPT beat in the AIQ, right? AIQ is just the AI ETF by 12%. It's not surprising to us because we just think that the air is sort of left the bag out of the AI trade. Now, maybe Round Hill with their DRAM ETF is moving on to the next frontier, right? So there was the enablers, now the adopters. Maybe that's sort of what is going on a little bit. But just purely year to date, we feel like the market is clearly telling us that, the AI winners, are not in things like AIQ. On a 1 year basis, RSPT has beaten AIQ by about 7%, 700 basis points. On a 3 year basis, AIQ is beaten by about 8-9%. On a 5 year basis, RSPT has beaten by about 10%. So, I think just in terms of how we think about things and, we're always trying to generate higher returns per lower unit of risk, we would choose RSPT, and I think the performance sort of backs it. So that's my category winner in the performance area.
That's a solid pick. Thank you, John. Now we move to the mystery battle category where our judges can give us that certain thing, that certain factor that they think is crucial to today's contest. So, John, what is your mystery battle category and which of these ETFs takes it?
So it's just more in line of sort of what exposures are you actually getting? And I feel like there's pros and cons for, things like DRAM, right? If you're trying to play the next frontier, the next leg of the AI trade. AIQ was a great trade. I think what Shana said earlier is spot on, right? We actually, when we run our quant stock SMAs, that's how we would do it, right? We cap the weight at 3% in AIQ. We'd go down the market cap range. That feels more of an institutional sort of category, portfolio construction. To have three names, 75%, that feels real risky. Overnight, Samsung had one of the best earnings in the history of all companies. And, the stock was down 10, 11% overnight in Asian hours. So, there's a lot of there's a lot of, sort of risk, I think, in the memory trade. So if you got in it, anywhere near the launch in April, you would have made, as Shana said, a lot of money. And I just think that you sort of have to be more prudent. So just from like a portfolio construction standpoint, I would sort of say like AIQ does what we think you should do in a portfolio, whereas DRAM is much more like niche. It's more of like a trade. So my category winner in that, from the portfolio construction standpoint, is AIQ.
Got it. Shana, you're up next. What is your mystery battle category? Which of these ETFs wins it?
It's not all that different from what John said. I am going to bring in my wild card again, AGIX. One of the things that I really like about AGIX is we're talking about a theme, and the theme here is AI, right? So if you buy DRAM, if you buy AIQ, the reason you're buying it is you're trying to benefit from the theme of AI. And in the case of DRAM, you're doing it in a very specific way, as it's only things related to memory and storage in AI. So it's very niche. And as John pointed out, it's 75% in 3 stocks. And those stocks are quite volatile. I mean, Micron's a perfect example. If you look at what Micron's done over time, it's done great, but it's also had periods of time where it's absolutely gotten hammered. And that's 25% of the total portfolio. You would live and die by 3 names. I don't necessarily have a problem with concentration. I do have problems with concentration and passive. So it's kind of a double-edged sword. You have concentration, right? And you do have volatility that comes with concentration when you only have 3 names. But when you're also passive, that means if things start to turn against you, there's no mechanism in which you can stop the bleeding necessarily. Now, did I go through the whole prospectus for Round Hills? No. And it's entirely possible that there's some mechanism somewhere deep in the prospectus that says if a particular name goes down more than a certain percent in a certain period of time, that they can make an adjustment. Some passive indexes do have that mechanism. But I didn't see anything like that. There's no mention of anything like that. And again, I didn't dive deep enough into the prospectus language to tell you if there's some mechanism to protect you. But being passive and not having the ability to, on a dime, make a choice, and even in the situation where these passive indexes do have a protection against something like this, there's usually like certain triggers that have to be set off over a specific period of time before it would trigger this protection mechanism. I just don't like concentration in passive funds. And that to me is a huge knock against DRAM. Yes, the fund has crushed since it launched, but it's because it owned 3 names that just happened to crush, and it will probably crush going through the rest of the year, especially again, since SK Hynix is one of the 3 companies that have more than a 25% weight in the fund. For me, I like AGIX because in this theme, a lot of the best names in innovation are going to come from the private market. And the fact that AGIX allows for up to 10% of its portfolio in private market companies is a benefit, in my opinion. The other thing I really like about this is that it is benefiting from some of these big name IPOs that are coming out. It clearly benefited from SpaceX, and it does own a good chunk of Anthropic, which has indicated that they intend to go public as well. I expect that to be a splashy IPO. So I really do like AGIX for that reason. It has similar exposures to AIQ. It is slightly more actively managed. It has this really cool proprietary exposure score for AI that helps it kind of weight the product so it's not just market cap weighted. It has a max position size of 10%, so there can be some concentration, certainly more than AIQ, where you can benefit from one name and the momentum of that name really working for you for some time. But it doesn't get to that 20-25% range. And I think for that reason, AGIX is my winner in this category.
Well, our judges have given us some great analysis on today's program, and we have already had 2 really, really awesome wildcard mentions. So now we move to the part of the program where our judges can give us their overall pick for today's contest. How will this go down? Shana, give us your final take.
I'm going to go with AGIX. I think we've all figured that out at this point. It actually has a very attractive expense ratio, too. It's actually cheaper than the other two funds at 45 basis points. Not as big a product. It's $767 million, so it's not at that $1 billion mark. It has a decent track record. It's been around since 2024. So it's obviously got a longer track record than DRAM. And again, I do like this public-private aspect that they have. I think it's brings some flavor into it that is important in this theme. So for me, AGIX is my winner.
John, your final chance to weigh in with your overall winner.
So I'm going to pick my wild card, RSPT, as the overall winner. A couple of reasons. One is we actually use it. So I just feel like it's, as a fiduciary, I should.
You're eating your own cooking.
To some degree, yeah. I mean, I think that, sort of DRAM is like, these guys are just geniuses, right, for what they did. But, we sort of use RSPT because I just don't think you can fade tech, right? But I'd rather be diversified. I'm always trying to generate higher returns per lower unit of risk. When you equal weight, you sort of let the market dictate, the winners and losers for you, as opposed to you saying, okay, these three stocks should be 75% of your ETF.
It's interesting, too, to me, John, how you picked RSPT over XLK.
Yeah. I mean, the market concentration risk we have now between, SPYs, Qs, or XLK, like it's epic, right? It's a 100-year extreme. So our whole firm is like, how do you tilt away? How do you, sort of diversify away from in the event that there is a sell-off in the AI trade? So it's not really surprising to us or to our clients that we would use something like an RSPT in sleeves of portfolios that we run. When we first started Astoria, I mean, we would equal weight all our quant stock models just because that's what I've always done, equal weight for 25 years when I was doing quant modeling at Merrill Lynch and Morgan Stanley. And then we had to sort of pivot like 3 years ago because market cap was starting to go much higher. So then our quant SMAs, couldn't really equal weight anymore because there was just, this sort of rally in the Mag 7 stocks. But in the last year, I'm seeing definitely a rotation. Like I said, the MAGS ETF from Ron Hill is down to flat on the year, whereas things like, equal weight strategies, like we run an equal weight fund, which is up like 20% year to date. And it's dramatically outperforming SPY. It's dramatically outperforming, the RSP ETF. Past performance not indicative of future results. Anyway, the point is like there is a rotation that's happening, and sort of we want to be there for clients. So we just like RSPT just because it'll like diversify across all of tech, and we think you should own tech because it makes up the lion's share of like earnings growth in S&P. And so we use that, and so that's my category winner for the reasons I've mentioned.
Well, our judges have spoken, and according to my final battle scorecard, today's winner is a split decision between wild cards. We had AGIX mentioned by Shana, and then, of course, RSPT from John. And both of those ETFs, like I said earlier, great mentions from wildcard perspectives. Shana pointed out that AGIX, she liked that one, obviously, with its unique approach of holding both public and private companies. As she pointed out, it can hold up to 10% of private companies. And, of course, companies nowadays are staying longer private as private enterprises, and they're going – when they do finally go IPO, they're like already like mega caps. So, but holding some private along with public gives AGIX some unique exposure. Also, capping that maximum exposure size of 10% has some discipline inside the ETF. And then John mentioning RSPT, he likes technology, but he likes it with a more balanced approach, that equal weight approach. And of course, each of our judges brought some great points and arguments to today's contest. And of course, to our viewer who recommended this particular matchup, 1309 GSK, thank you very much for today's suggestion. Be sure to get in touch with our judges. In the description section below, I've got links to both of them. How did you enjoy today's episode? Hit me up in the comment section below. While you're down there, send me your next ETF battle requests with tickers. Thanks for watching. We'll see you on the next episode. I'm Ron DeLegge.